Okay, let's jump right into this explainer. Today, we're putting Borr Drilling through the ultimate guru gauntlet to uncover its true value. Is this offshore driller a hidden gem just waiting to be scooped up, or is it a classic value trap? We're going to put on our expert investment analyst hats today and take a really comprehensive look at the stock. We'll run it through the strict frameworks of legendary investors, project out some future cash flows, and size up the competition. Honestly, it's the absolute best way to separate the noise from the raw numbers. Let's get into it.
So here's our roadmap for today. 1. Company snapshot. 2. The Buffett and Lynch lenses. 3. The Benjamin Graham lens. 4. DCF valuation. 5. Alternative models. And 6. Synthesis and final verdict.
All right, Section 1, Company Snapshot. Before we start judging, we need to know exactly who we're dealing with. Borr Drilling, ticker symbol BORR, is an offshore shallow water drilling contractor. Right now, they're trading right around $5.20 a share, which gives them a market cap of about $1.4 billion. What they actually do is operate this really modern fleet of 34 high-specification jackup rigs, and they're deployed everywhere. We're talking the North Sea, the Middle East, the Americas, the whole shebang.
You know, there's a really great quote about them that highlights exactly what we're going to be unpacking. It calls their situation a market tug of war between being undervalued and having very real valuation risk. And that is so spot on. On one side, you've got this expanding fleet and rising offshore demand. Sounds great, right? But on the flip side, they're carrying a highly leveraged balance sheet and some real recent earnings volatility. So who's right in this tug of war? Let's find out.
Moving to Section 2, the Buffett and Lynch lenses. Let's see how Borat holds up against the golden rules of two absolute legends.
First up, Warren Buffett. And, well, it's a bit of a tough crowd for Borr here. The offshore drilling industry is notoriously cyclical, which means Borr's economic moat is pretty weak. Buffett absolutely demands consistent, positive earnings, but Borr just reported a Q1 2026 net loss of $29 million. Ouch. Because of those losses, their return on equity, which is a classic measure of how effectively management uses investors' money, is completely negative right now. But the biggest red flag for Buffett? The debt. Borr is sitting on a staggering $2.48 billion in gross debt. But actually, let's pause for a second because there is a bright spot. If we calculate their approximate owner earnings, basically the true cash an owner could actually pocket, using projected 2026 free operating cash flow, we see a positive $136 million. And that's projected to jump to $165 million in 2027. So the underlying business does generate cash. It's just that Buffett would likely only buy in at a massive, massive discount to make up for that heavy debt load and the lack of a protective moat. Okay, shifting gears to Peter Lynch. Through his lens, Borr is a textbook cyclical turnaround play. But here's the catch. They have a sky-high PE ratio of 48.6 times. Lynch is all about a low PEG ratio, meaning you only pay a high multiple if there's explosive growth to back it up. So paying a 48x premium for a highly leveraged, cyclical company? Yeah, that completely violates core Lynch principles. For him, this is definitely an avoid or, at best, a hold.
All right, Section 3, the Benjamin Graham lens. We're moving on to the godfather of value investing himself, who leaves literally zero room for speculation. If you know Graham, you probably know where this is going. Borr fails almost every single point on Graham's defensive checklist. Now, it does pass the adequate size test with that $1.4 billion market cap. But the rest, it fails on financial condition because of the huge leverage. It fails on earnings stability because of recent losses. It doesn't have any dividend record. And a PEOE of 48.6? No way! That completely disqualifies it from being a moderate value play in Graham's book.
So what does this actually mean in dollars and cents? What happens when we run the raw math on Graham's famous intrinsic value formula to find a margin of safety?
Well, it breaks. Because Borr's trailing earnings per share are negative, the whole formula just breaks down to a big, fat zero. Without positive earnings to anchor the math, a strict Graham analysis yields absolutely zero margin of safety at the current $5.20 price tag. Graham literally wouldn't touch this stock at any price.
Okay, let's step out of the past. Section 4, discounted cash flow valuation. Let's look forward instead of backward. This is where Borr's story actually starts to get kind of interesting.
So we built a base case DCF, we assumed a 10% weighted average cost of capital, which accounts for the steep rate they pay to finance that massive debt, and a conservative 2% perpetual terminal growth rate. Using the projected $136 million in free cash flow for 2026 and $165 million for 2027, our model spits out a fair value of $5.84 per share. This is super important because it shows a fundamental gap. Compared to today's price, this forward-looking model suggests Borr is actually modestly undervalued, sitting at roughly a 10.9% discount.
But, and this is a big but, look how fragile that valuation is. If interest rates rise and push that WACC up to 12%, boom, the stock is instantly overvalued at $5.15 today. On the flip side, if they execute flawlessly and we drop the risk premium down to an 8% WACC, fair value shoots up to $6.80. Ultimately, your margin of safety here entirely depends on Borr's ability to refinance its debt seamlessly and keep those rigs working without any major macroeconomic hiccups. Section 5. Alternative Valuation Models. We never want to rely on just one single metric, right? So let's cross-reference our DCF with how the broader market is valuing Borr compared to its peers. And honestly, the sheer premium the market is currently placing on Borr is wild. They're trading at nearly double the industry average and almost 4 times their peer average of 12.5x. Investors are clearly pricing in massive future growth based on the idea of an upcoming offshore drilling upcycle. But let's play devil's advocate. What if that hype cools down? If Borr's valuation reverted back to that peer average of 12.5 times, the fair value per share would absolutely plummet to around $1.33. That is a severe valuation risk for any investor if those aggressive growth expectations suddenly stall out, or if day rates just start to normalize instead of continuing to climb. Which brings us to Section 6, Synthesis and Final Verdict. We've run the absolute gauntlet today. Let's pull it all together and find the true center of gravity for Borr Drilling. Just look at the extreme volatility we've uncovered. Depending on the model, this stock ranges from completely worthless on a trailing, risk-averse basis, all the way to modestly undervalued at $5.84 on a forward-looking cash flow basis. The historical frameworks, like Graham, are screaming at us to avoid it, while the cash flow projections are whispering that there's still some upside to grab. So what's the ultimate verdict? We're calling it a hold. Yes, the company is beautifully positioned for an offshore upcycle. They've got 34 modern rigs and fantastic visibility with 70% of their 2026 contracts already covered at strong day rates. But the risks are just too pronounced to ignore. That $2.48 billion in debt massively limits their flexibility. Plus, recent operational delays, like standbys in the Middle East, prove exactly how quickly cash flow can get disrupted in this business. If you're waiting for one of our legendary gurus to actually pull the trigger and buy, Borr has to fundamentally shift its strategy. They need to use that incoming cash to aggressively pay down their debt, rather than just financing more rigs. If they can hit that $165 million free cash flow target in 2027 and dedicate it purely to deleveraging, the risk profile changes completely. But until that happens, you are absolutely paying a high premium for a highly leveraged asset. So I'll leave you with this final thought to ponder based on your own personal risk tolerance. Is the offshore drilling upcycle worth taking on that high leverage risk, or are you just paying a massive premium for a cycle that might stall out? Thank you so much for joining this explainer. Keep these guru frameworks in your back pocket the next time you review an energy stock, and remember, balancing future cash flows against current debt is absolutely the ultimate key to finding true intrinsic value. Catch you next time.